Well, thanks so much for tuning into this earnings conversation with the management of PVR. They've come out with the numbers just about half an hour, 45 minutes ago. Sequentially, YOY, of course, the numbers look good, and I'm sure Q1 YOY also they look really strong. But sequentially, about a 12% odd slip in the top line and about a 35 or 37% slip on the EBITDA level. And largely to be expected simply because we did have a COVID wave running in the month of January, which would have impacted the quarter. The questions, though, would be about what are the positives that they can take out from Q3 and Q4 as India has opened up, and how do they look at presumably not necessarily a post-merger scenario, but a few thoughts around that as well. Nitin Sood joins to talk about that. Nitin, great having you. Thanks for joining in. Hope all is well.
Thanks, Neeraj. Thank you.
Okay, so Nitin, first, the quarterly numbers. Is it? You would have expected this question, but was there something on the cost side which stayed very elevated? Because I saw a 12% sequential, I'm using sequential, but a 12% slip in revenues, which was fine, but leading to about a 39% odd slip in the EBITDA numbers.
Yeah, so effectively, when we ended the last quarter, we were actually fully ramped up to restart operations. Cinemas had really opened up across the country without capacity restrictions after a fairly long time. And our season really started in November with Diwali as the big releases started coming. So we had fully ramped up our operations. We had fully got all our people back, incentivized teams to put stuff in place, finished our negotiation with landlords for a rental relief, etc. All of that had happened. And in fact, in December, as the films were doing exceedingly well, we were on the ramp-up phase. We were hiring people. We had given increments to people. After a long time or lull. So all of this was happening till the time we hit the third wave of COVID in January. But this time we were reasonably confident that things will bounce back quickly, which they did. And as a result of which, a lot of the cost increases that we had done, as compared to the earlier two waves, the first wave, which was 8 months, and the second wave, which was roughly 4 to 5 months, this time was 1 month, and we didn't want to bring down the momentum, and it was not possible for us to cut down costs at such a fast pace in that window. And yes, costs did remain elevated during the month of January and February, till the time film releases begin to happen. Which is largely the reason for the EBITDA loss. Film releases started happening mid-February onwards for us, and March was a full month of operations. And we did, potentially revenues and earnings which were similar to what we were doing in pre-COVID.
Yeah, actually, come to think of it, if you compare a 2-month quarter versus a 3-month quarter, largely, would you say that it's actually turned out even better than what Q3 would have been? Because, for example, I saw a lot of my friends go to South Indian releases and, hoot and whistle in a multiplex, and the capacity, the screens were full. So would you say that Feb and March kind of actually did much better like to like than what 2 months in the third quarter would have been?
You're right in some sense. For example, the month of December, which was a big month for us to signal the bounce back, did about 65 lakh admissions during Q3. The month of March did 90 lakh admissions, almost 40% higher than what we did in December. I think people gained a lot of confidence as they stepped into theaters during December, and a lot more people came back. And as we saw restrictions getting removed and full release calendar coming out to play, it really reflected in the numbers that theaters have done. April has continued with that journey. We are hoping, May and June will be as good as months as what we saw in March. And hopefully we'll have a full, revenue and a full earnings quarter now after 2 years.
Inshallah, as they say. Wondering the average ticket prices, which had moved up 18% QOQ in Q3 to, I presume, what was the highest that you've seen? Have they inched up even further in Q4?
Yeah, so they've sustained at similar levels. Our average ticket price was about 242 rupees, which is about 18 to 19% higher. And I said last time, the primary reason for that has been that Cinemas haven't seen any ticket price hike for last 3 years. We've been shut on account the cinema industry had saw GST relief with rates coming down from 28 to 18% and passed on that entire benefit to the consumers. So I think we were due for a pricing correction to that extent. I would say this year is special from that perspective. In addition to that, we've also have a lot of big content releases with shorter time frames and gaps in between, which is enabled to keep the ticket price higher.
Interesting. So you're saying right now the ticket prices are even higher than what the quarter 4 averages were?
No, they're at almost similar levels.
Similar levels. Okay, fair call. Now, in 3Q results, you had mentioned that the negotiations for rents and common area charges were underway. I heard you say right now, just about 2 minutes ago, that now they are behind you. Can you tell us how they have transpired?
Yeah, so like I said, Q4 is so tough to get any significant discounts from landlords because this time around we were not shut down. The government allowed cinemas to remain open across the country, but introduced capacity restrictions and no new content was getting released. So it was tougher. Only states of Delhi and Haryana were shut for a month. And by December, we had agreed to start paying full rental. So this time it was still tough. But our average discounts during the quarter were about 18% on rentals. But by March, when we had full operation, the discounts were almost negligible. So, starting this year, we'll be paying fully contracted rentals to our landlords who supported us for the last 2 years.
Okay. A small thing, but I think in a broker report that I read, there's some issue with the Andhra Pradesh government, right? Wherein it comes to booking on a common portal which is government owned, and I think you guys or the industry and the Andhra Pradesh government might be in some bit of litigation. Can you fill us in on what this is, and is it material, even though Andhra Pradesh may not be as large a state per se?
Yeah, so for PVR per se, we have very limited presence in Andhra Pradesh. We have only 2 theaters, but I think broadly the issue is that the Andhra Pradesh government has come out with a notification which requires all theaters in that state to sell tickets online only through the government portal and not through anybody else. So, which is quite an inefficient way of doing it. Plus, it's not fair on private operators and cinema operators who've invested of capital to to build the infrastructure, do a service delivery, etc. I'm not very sure what the thought behind that is. Maybe it is to cover largely the single screens theater or that part of the industry where the bit of transparency in terms of collections, etc., are not similar to what most of the multiplexes do. But I think we are in dialogue with the government on that. We've kind of filed a petition against the government challenging that order. So that's currently work in progress.
Okay. Nitin, one more business question and then a couple of other questions. The business question is why, and I hope you can hear me clearly, subject to any internet issues, but
yes,
as much as there is competition because of stay at home and the portals, etc., and the Amazon Primes and the Hotstars of the world, I now, as I said, start seeing hitherto not seen frenzy for, say, for example, South Indian content in non-South Indian states as well, right? So is the market truly opening up in that you don't now just look for Bollywood blockbusters in Bombay and rest of India, but even some of the other regional content which is getting more popular? So is the number of high duty or heavy duty releases for a chain like yours permanently changed, in that they will permanently be more than what you've experienced in a 12-month block in the past?
I think it would, and I, in some sense, we have to thank OTT platforms for that. Like we've always said that I think India has been a low entertainment consumption market, and as people consume more entertainment at home, they are likely to consume more out-of-home entertainment as well. I think as more and more Indian consumers are consuming multilingual content on their television screens, the South Indian films being dubbed in Hindi languages, showing on the television screens, or a Korean show or a French show being dubbed, the receptiveness to consume more multilingual content has become high. And I personally think that's very good for the industry, simply because South Indian film industry especially creates some very larger than life content, which is more massy in nature. And the 2 or 3 big films like Pushpa, RRR, and KGF2 have demonstrated that there is a huge market and appetite to consume content, even if it is not in the native language. And I think that augurs well for the industry, which means that people will try and make films on a bigger scale for the masses. And cinema is always larger than life. You go to theaters for an experience which you can't replicate at home.
Yeah.
And some of these films, you can't just catch the visual appeal on your television screen or the sound effect. So I think this trend is likely to stay and grow from here.
Okay, great. Now, 2 or 3 questions, Nitin. I have limited time with you, 3 more minutes left, but I would still ask you, you can choose to tell me that you don't have the answer right now to these, but 1, screen additions, 1, standalone entity, 2, as a potential combined entity, and how do you think the ROIC roadmap would be in either of the cases?
Yeah, so we've given a screen guidance of about 125 screens that we intend to open this year. This will be our highest ever screen opening in a fiscal year. And this is largely because, we have a huge backlog of screens to execute. We think the number could potentially turn out to be higher if we manage to execute everything. Simply because, there is just too much locations and malls which are waiting to open. I think a lot of retail destinations have opened during the last 12 months. I think multiplexes as the only industry has kind of shied away from capex and fitting out new screens. But we've started our new build out plans in the full way. I think our competitors right now, our competitors but potential partners, Inox, have also given a screen guidance of about 77 screens. So about a 200 screen opening this year between both of us is what the individual guidance both the companies have given.
Okay, and you suspect that the ROC up move, is there some sense that you can give about that?
Yeah, see, as the industry hits towards maturity, as the earnings come back to regular level, ROC will definitely move up. In fact, all our mature screen portfolio, even prior to the pandemic, was doing very strong ROCs. It's just that we made 2-3 acquisitions as part of our operating journey. And if you look at our ROC metrics, even pre-pandemic, and you exclude the SPI acquisition, which we had done in 2018, our ROC on the rest of the portfolio was very strong, close to about 20% pre-tax. And as the acquisitions take slightly longer to pay back, so you'll have to give them 2-3 years extra before their ROCs also start reflecting on the screen. But the combined entity should deliver very strong ROCs.
Okay, my final question, Nitin. Should, God forbid, but if it doesn't pass, say, the CCI muster or something like that, would PVR be open to, selling off partial stake or full stake to a large corporate entity? Because I see a lot of interest in this business now with all the reasons that you enumerated.
To be honest, we don't need any capital for now. The business, hopefully this year, will have a very strong operating earnings. We fund all our, expansion from internal accruals. So leaving aside the merger, I think the company is fairly well-sufficient, well-funded, doesn't need any more cash for growth. Most of the money should come from internal accruals. So that's what it is.
Great. Well, Nitin, wish you all the best to keep the theaters running. They are great sources of alternate entertainment now that we have opened up, and all the best for a fairly strong Q1. All right. Viewers, thank you for tuning in to this conversation.